Okay, we are live with Sir Daniel Patton, mortgage broker with BM Select Mortgages. He's helped a ton of Rockstar Inner Circle members, myself, with their mortgages, and just a very valuable resource. So I wanted to bring Dan in to ask him specifically about how to handle your mortgage payment in an environment where rates are going up. So we've had some Rockstar Inner Circle members reach out to us and ask, why are some of their variable mortgage payments staying the same for them, even though rates have gone up?
Really good question. Thanks again for having me back. Always a pleasure to be in the podcast room at Rockstar with you, Anthony. I appreciate the chance to chat. Very simple. There's two types of variable product, right? One is a static variable. A static variable is a variable rate product where the payments don't change initially. The payments will stay the same. As prime rate increases, the payments will stay the same. There's a regular variable rate where the payments do change, where the amortization basically stays on schedule. So what happens is when you have a mortgage payment and variable rates based on the Bank of Canada's prime rate, right? Prime today sits at 4.7%.
Okay.
If you have a discount to prime, let's say it's prime minus 50, your 4.7 minus 50 is 4.2%. Well, if prime rate goes up, your rate's going up, right? That's what happens when you have a variable rate. Your rate will go up. Well, some mortgage products have a payment that will change. Some mortgage products have a payment that won't change. When it changes, what's happening is you're staying on the same amortization schedule. So if you're in a 25-year amortization and your mortgage payment is changing, you're staying on the same schedule, right? It's a higher monthly cost, but you're still staying on your 25, 24, whatever it is on schedule with that amortization. What happens with a static variable rate is the payment stays the same, but the amortization is essentially getting pushed back because the interest to principal component changes in the payment. So the payment stays the same, but remember, when you take a mortgage and you're paying 50% roughly of interest, 50% roughly of principal, that's your initial on a regular variable rate, roughly. If rates go up, you're not paying 50-50 anymore. You're now paying 60% interest, 40% principal, 70% interest, 70% principal, or 30% principal. So it can fluctuate, but the payment remains the same until you hit what's called a trigger rate. And then then things change.
Sure. And so the trigger rate is called in when the interest just becomes too much,
right?
And you're not paying enough principal. How does that work?
So what happens is this: when you have the payment that changes with prime rate, it's just going to change, right? Rates go up, your payment goes up. Rates go down, your payment will go down. It stays the same. You stay on the same amortization. But what happens with the other people when they have the static variable where the payment stays the same? Sorry, I was saying before the payment changes. And this one where the payment stays the same, you're paying essentially, say, 50%. Let's just give you an example. Let's say you have a $2,000 a month mortgage payment and you're paying 50% interest and 50% principal. When rates go up, that's going to change, right? Like I said before, you're going to go from 70% interest to maybe 30% principal. Okay. But at some point, if rates continue to go up like they have this year, rates have gone up 2.25%. That's a lot. A lot of people who bought at the beginning of this year where effectively, maybe they were paying 60-40. When you hit that point where your interest component is 100% of your payment, that's your trigger rate. So your interest is now covering 100% of that mortgage payment that hasn't been changing. And that's what initiates the trigger rate. And that's what initiates three options for those people. So when I say the payment doesn't change, it doesn't change until it hits the trigger rate. The trigger rate is when your mortgage payment becomes essentially interest only and no more principal. That's what happens.
If someone has a static variable rate mortgage and they want to check in on how close they are getting to that trigger rate, how are they able to do so?
So there's a rough calculation you can do. I would always tell anybody to check with their bank for sure to confirm it, but there's a rough calculation you can do. It's pretty simple. You'd want to know, I need to know the annualized payment that you're making on your mortgage. So if you have your calculator, we can do this together.
Sure, yeah.
So let's just say, for example, you have a $700,000 mortgage. Okay. And you're paying $3,500 a month. So I need your annual payment. So $3,500 a month times 12 is the first thing I'm going to do. 3,500 times 12. Then I'm going to divide that number by the mortgage amount that I have owing. So divide that number by, let's say I owe $750,000.
$750,000.
Yep. $750,000. Then you're going to take that number and you're going to multiply that by 100.
Okay. So 0.056 times 100. 5.6.
So 5.6 is roughly your trigger rate.
that's the interest rate where you're now paying 100%
That's right.
interest.
That's a rough idea. Yeah. That'll give you a rough idea on calculation. If you're trying to figure out how close you are to the trigger rate, you need your annualized mortgage payment. So if your monthly mortgage payment times 12, semi-monthly times 24, biweekly times 26, divided by the mortgage amount owing times 100.
Okay. Well, that's handy.
It's rough. Like I said,
Okay.
I may check with your bank, but that's just
Sure, but it gives people an idea if it's coming up for them.
That's right.
And then, so what are the options once that trigger rate?
So what happens when the trigger rate happens is the bank will call you and they'll say, look, you're at 100% interest basically. And you have one of three options. One, you can make a lump sum payment, okay, to bring your principal balance down, sort of reset the amortization, keep the payment the same. You can do a lump sum payment. You can lock it into a fixed rate, okay? At a new amortization, lock it into a fixed rate. Your payment is likely going up in that case anyways, because it depends on what fixed rates are, but you can lock it into a fixed rate, or you can increase your monthly payments on the variable. So inevitably, if rates go up enough, which, in a lot of cases this year they have, you will hit that trigger rate.
To increase your monthly payments on the variable, are you able to select what you want your payment to be and keep the static? Like, how does that work?
Well, it'll reset the amortization. So yeah, they'll give you options on how high you can increase the payments, what amortization, like they'll give you options on that.
So there's some flexibility there.
Yeah, there's some flexibility.
Be kind of slapped with this one option.
But if you've gone 3-4 months without making any increases to your payment, you may get hit with a higher cost than, the other way. Remember, when your payment changes, it's gradual. What people don't like about this is that it's all of a sudden, it's a massive increase. Well, not massive, but much larger increase all at once. Sort of like property tax, right? Some people like paying their property tax every month. Why? Because they just pay it every month. It's a lower cost. A lot of people hate getting that bill at the end of the year and pay it as a one time. They don't like paying it. So psychologically, people are affected more when that trigger rate kicks in because it's affecting them more at that time. Whereas the people who have had the slower increases, although they don't think it's helping them, remember, when you're in the position where your mortgage payment is going up, in a way, when you're looking at people where the payment's not changing, you think you're losing, right? You're looking at your payment going, I'm losing on cash flow, my interest rate's going up, and here's these people over here whose payment's not changing. But the reality is you are staying on your amortization schedule. That's key. You're paying off debt. Forget the cash flow. The cash flow is a good argument, right? I can't argue that.
Yeah, because it's money now versus money later.
Right. Exactly. So you're losing cash flow, but you're paying off principal. In finance, you can't say that's bad in a sense, right? The other people who are paying more interest, well, the argument there is, yeah, your payment's staying the same, but you might be sacrificing long-term money for short-term gains. So just a perspective thing, right? That's all.
Okay. And if it's not clear for anyone, what's your opinion on why money now saved might be better than money later?
Well, I think in anything you're trying to pay off debt, right? I mean, it's nice to leverage deductible debt, but I'm not trying to sit here and say like one is better than the other because everybody's scenario is individual to themselves, right? Just in terms of if the payment's changing, how much does it affect Anthony versus how much does it affect Dan, right? Maybe it affects Dan way more than it affects Anthony. We don't know. But it's going to affect everybody differently. So my point is, from an overall perspective, to the people who felt like or feel like maybe I'm at a disadvantage because my payments have been going up every month, you're not. That's the message. It's not one's better than the other. It's neither are worse off. The bank's going to get their money one way or the other when rates go up. That's the way it works. They're getting their money.
Okay.
So one, you're paying off more principal. The other, you're saving on monthly payments. For sure, that might be more beneficial to you, but you're not paying off the principal as much.
Okay. So yeah, with rates going up, it could be a reality that some people might be hitting their trigger rate.
Yeah, especially if you sort of started at the beginning of the year, maybe at 3.5% or even lower, 3%, and now your variable rate's at 4.5%, potentially going up more in September. We anticipated going up in September. How much, we're not sure. The U.S. went up 75 basis points. We usually reflect the U.S.
So maybe just do that calculation to see if
you're worried. Yeah.
Is it breaking your mortgage when the trigger rate happens, or they just readjust?
Yeah, there's no penalty.
There's no penalties or anything?
No, it's just a readjustment.
Okay, and so I've heard the term cash call, and is that means, like you mentioned that earlier, one of the options was you have to put up a lump sum payment. So that could be your cash call.
Yeah.
That's one of the options. Okay. Is it possible to extend your amortization period to lower your monthly payment with rates going up?
Yeah, it's a really good question. We get asked this a lot as well. What are other things we can do to sort of offset the increasing costs of our mortgage? If you've been in a mortgage for 5 years, 10 years, 15 years, a lot of the times your bank will offer you the opportunity to reset your amortization to the most recent contract. Excuse me. So if you're 15 years in and the most recent one you signed was a 20-year amortization, they might let you push it back to 20 years, back to 25, back to 30. So we'll see a lot of investors going to their banks and asking to reset the amortization on their rental. There's no penalty for that. There's no cost.
Is that only on renewal? You're allowed to do
No,
that?
you can do that at any point during your mortgage term.
No penalty?
Yeah, no penalty during the 5 years. Yeah, you can call your bank and ask them to reset the amortization. A lot of people who have increased their monthly payments, when rates were low, people increased their monthly payments, right? They doubled up. When you do prepayments at a bank, there's two ways to prepay. One is a lump sum. Another is to increase your payments. So believe it or not, a lot of people do that. They increase their payments. They don't know that you can reset it back. So that does happen. People will increase their payments. They find themselves maybe a little cash strapped in these times, and they'll go back to the bank and push back the amortization without penalty.
So to increase their payments, they shorten the amortization?
Yes.
So they could start paying their mortgage down faster?
Yeah.
Huh.
Well, that's what you're doing, right? When you increase your monthly payment, you're just shortening the life of the amortization because you're paying the mortgage off quicker.
Okay. And then just because rates are going up, some people might be getting squeezed on the cash flow and stuff. Just want to go through all the options here for people to kind of manage their cash flow and payments. True or false? You can skip a mortgage payment if you need to with zero repercussions.
Well, yes, you can skip a mortgage payment, but I wouldn't say with zero repercussions. Okay. Number one, you have to pay it back. So there's a repercussion. You have to pay it back. But yes, most banks will allow you the opportunity to skip a mortgage payment.
Just one payment.
That is true. Yes, just one payment. Yep. But much like when COVID hit, right? Didn't they have that program? Didn't they have a name for it or anything?
Yeah, wasn't it like 6-month mortgage deferrals?
Yeah, the deferral. That's what it was. Yeah, the deferral. Yeah. Not quite the same thing, but a bank will work with you to miss a payment. Yeah, they've done that before for sure.
Okay. So
I don't advise it.
Sure. Yeah.
Because you have to pay it back, and you're going to be at some point there. You have to have a plan to get that back. So, skipping a payment because you can't afford the monthly payment is just more of a signal of more imminent danger than just locking it in.
It's not a good place to be in. It's almost like a last case scenario.
Yeah, definitely.
Okay, and then how do you apply for that? You just talk to your bank?
Yeah, there's no application for something like that.
Okay, just at your branch level?
Yep.
Or mortgage specialist?
Yeah, you just call your bank. Yep, whoever holds it. Not even at the branch. You just call like the toll-free number and let them know what you're trying to do, and they'll probably give you somebody. Maybe they'll have somebody reach out to you.
Okay, and then how do the penalties to break a mortgage work in a rising rate environment?
So when you're taking a variable rate and you have a variable rate, one of the things we like about it is we always know what the penalty is. It's 3 months interest, right? So we can sort of...
Is that across the board, every variable rate?
Well, no, because some variable rates will come with small attachments. You have to be careful when you're buying. This is where a good mortgage broker sort of talks to you about different product. For the most part, if when you're going to a big bank and you take a variable, yes, that's 3 months interest, no penalty. Mm-hmm. But sometimes there's small monoline lenders that, offer discounted rates with certain restrictions on their mortgage. They'll give you a variable rate, but they won't let you break that mortgage unless you're selling the home. So there, you can sometimes sacrifice rate for restrictions, but not usually at a big bank. That's one of the reasons why I favor big bank. Rate is important, but not the driving force. We like options. So the variable penalty is always 3 months interest. We know that. We can count on it when we're with a big bank. We can call the bank and double check that if we're curious, but that's generally the payment. You can calculate that because it's usually about, nowadays with these rates, you could be paying roughly 60% interest, 40% principal. So, maybe half your mortgage payment times 3, add a little bit. Like you can get a general idea, but you can call your bank and confirm that. When you're in a fixed rate, the fixed rates penalty are based on the bonds at the time you want to break the mortgage. So an easy way to look at a fixed rate penalty is like this. If Anthony got a property in 2021 and interest rates were 2.69% right now, okay? You locked in at 2.69 a year ago. You were smart. You did that. You knew what was going to happen. You locked in at 2.69. Now let's imagine a scenario where 2 years later, you want to break that mortgage. You're going to go buy a new house, okay? And you're going to sell this house and go buy a new house. And you're wondering, what's my penalty to break the mortgage, okay? First things the bank's going to look at is what are rates now, okay? If rates are higher and they can break your mortgage and relend your money out at a higher rate, 4.5%, if that's where rates are today.
Yeah.
That's more beneficial for the bank. They're going to charge you a 3-month interest penalty, and then they're going to relend that money out at a higher yield. They're going to make more money.
Bastards.
Well, business, that's the thing. It's a business, right? When you have, reverse that now, right? That's a 3-month interest penalty. Because when you have a fixed rate, the bank says your penalty is either 3 months interest or interest rate differential, whichever is greater of the two. So in a scenario like that where rates are low or higher and it's in the best interest of the bank, they're going to give you the 3-month penalty because it's better for them. They're going to make more money. But let's reverse that. Let's imagine you locked in a year ago and you had 4.69%. And now rates are 2.69%. The bank is now going to look at your file and go, well, wait a second, Anthony, you agreed to pay us for $400,000 for the next 5 years at 4.69%. And now you want to break that mortgage and we have to relend that money out $400,000 for the next 4 years because you're 1 year in at 2.69. Well, that's not good for us. So we're going to figure out how much money we're going to lose by having to relend that money out at today's rates. And we're going to charge you the penalty.
Bastards.
That's interest rate.
They win no matter what.
So, and that happened, when COVID hit, imagine, right? When right before COVID, we were at a time where interest rates were starting to climb up, right? There was that thought that like, hey, variable rate was high, fixed rates were starting to climb. It was like, get in. Those low rates are over. It's time to get in. And a lot of people locked into their fixed rates. 3.79, 3.89, 4%. Like people in our office locked in at 4% because that was best fixed rates at the time. But what happened when COVID hit, right? The first thing that they did to try to stimulate the market when there was fear of a recession was they dropped interest rates. They wanted to promote buying, consumer spending. Yeah. So when they dropped interest rates down to like 2.69, 2.49, what do you think all the people with 4% did? They start calling their bank and saying, well, wait a second. I want to break this. I want to take advantage of these 1.5 variables and 2% fixed. Well, that's where the bank says, not so fast. You agreed to a 5-year fix. Let's figure out what your penalty is. And we got a lot of calls back then from people saying, hey, Dan, I want to break my mortgage. I'm at 4%. I want to take a lower rate. I got to see if it's worth it. And very rarely is it ever worth it, because as soon as they go to that's the first thing I say to them is call your bank and find out your penalty. And as soon as they call their bank and find out their penalty, they realize it's too much money. They'll never save that back by breaking the mortgage and taking a lower rate. They won't. The penalty is not designed like that.
Okay. Any other tips about managing mortgage payments in an environment with rates going up?
Yeah, I think it's important, especially if you're in a position where you have, you're feeling the cash trap. I think it's important to sit down with somebody that understands financial planning, whether it be a mortgage agent or a mortgage planner or a financial planner. I think it's important to look at an overall portfolio these days. We'll get a lot of people that have mortgage payments, that have car payments, that have credit card payments. Debt consolidation becomes more and more important now. We'll have people that have, like, imagine you have again, I keep saying these numbers just because it's easy for me, but imagine you have a $400,000 mortgage. Okay, and you've been paying it off for however long. Let's just imagine you're a non-investor for a second. Let's just imagine you just own a home. You've been paying it off. It's worth $1 million, but you have a high mortgage payment on it. You're paying $2,500 a month right now, okay, on this $400,000, because you're paying it off quickly. You've been told, I want to pay off my non-deductible debt. That's good. You increase your payments, you're paying it off, right? Then you add in a car payment for like $600-700. Then you add in maybe some credit cards, another $500-600. Pretty quick, you're up close to $4,000 a month you're spending, right? Now, an investor like that might, I said I was an investor, but let's just imagine, I always go back to investor, but let's just imagine this person is thinking about investing, okay? And they're going, well, look, Dan, I don't want to go buy a property right now, because if I go buy a property, it's barely going to cash flow. It's going to cash flow $100 a month, and I that's not a good investment for me. I'd rather just hold. Well, we'll spend a lot of time with that investor reevaluating their overall portfolio, right? If you have a mortgage that's at $2,500 a month, I love paying it off quick. But if you're looking to get into investing and you're looking to offset that negative cash flow, one thing you can look at doing, like you mentioned, is lowering your mortgage payment. So maybe you lower that mortgage payment back to a 30-year AM. $400K on a 30-year AM, you might get it down to $1,800, $1,900 a month. Now you just save $500. Well, maybe if you do a refinance, maybe you pay off the car, right? Maybe you throw that $30,000 or $20,000 loan into the mortgage, and it really only makes a difference of maybe $50 to $70 a month. So overall, restructuring of somebody's portfolio can really help from a cash flow perspective, especially if they own rentals or are looking to buy, because what they think may not be, attainable in a sense, just because of the cash flow,
Yeah.
might be just by rearranging some of the debt on their own property. That's all. Cash flow, listen, we all love cash flow, and I get it, but it's harder, and especially in Southern Ontario, to make cash flow numbers work. So cash flow in these days for a lot of investors just becomes more about overall affordability, not just the cash flow on this particular property. I don't want to make it sound like I'm anti-cash flow. I'm very pro-cash flow, but that's what an investor can do if they're getting to the point where they're not comfortable with their payments. They're starting to see, in the negative. It's like, look, maybe we just look at your overall portfolio. Maybe we refinance, pay off some debt, pay off a car, get rid of this, restretch out amortizations. There's different things you can do.
How do you actually apply to restretch that out? Is that also with your bank branch?
Yeah, just on something like that would be more of a requalification, because if you're trying to borrow money through the mortgage, like in this scenario, I said we might be paying off debt or a car. That's a restructuring. When you're restructuring your mortgage and pulling money out, then you have to apply. You have to go through the income verification, the appraisal, usually things like that. That's when I can reset the amortization. I sort of do
So can you work with a mortgage broker like yourself to do that?
For that. If you want to just stretch out the amortization, if that's all, you're not looking to restructure. If you're just thinking, well, maybe I'll just call and stretch out the am, that you would call the branch direct, the bank direct.
Okay. You're talking about total restructuring.
If you're pulling out money or restructuring on a refi, you would come to the broker. If you're just stretching out the amortization, you'd go to the branch of the bank.
Okay. Is that everything then?
There's probably more, but
yeah, I think that's all I got.
I'll come back. Thank you, man.
Okay. Thanks, Dan.